Hey guys, and welcome back to the Finance Now podcast. This podcast is purely for informational and educational purposes, and it's my way of sharing my knowledge, research, and opinions with you. I'm Anurag Birla, and once again, as usual, starting this week off with the macro debrief. So, from the last week, all we really saw was PMI come in for both manufacturing and services. So, for those that don't know, PMI stands for Purchasing Managers Index, and what this essentially tells us is an overarching business outlook of the manufacturing and services sector respectively, right? The way this figure is derived is through surveys of managers within both the manufacturing and services sector each, and that essentially acts as a leading indicator of some sort of economic or business activity within those two sectors, and a general gauge or a general guide to understanding PMI is that a reading above 50 signals expansion and a reading below 50 signals contraction. So in positive light, both numbers for manufacturing and services were above 50 after the last reading of the manufacturing PMI coming in below 50. So this shows some, uptake in business consensus, business outlook, activity, and it also shows some solid resilience within these sectors, namely the manufacturing sector. Aside from that, we didn't really see much except the big main event, which was Jackson Hole and what Powell had to say on Friday. So a few takeaways here, right? There is very clearly a case for a September cut, and Powell made that pretty explicitly clear. The markets see a pretty definitive path to it. Traders seem to have priced in a high probability that there will be a rate cut in September, and that is essentially what spurred a mini rally on Friday during trading hours. It is important to note that despite this dialogue, of course, the labor market has shown weakness, and Powell did touch on that too, but despite this dialogue around the labor market, the effects of inflation are starting to be seen, right, in PPI, and that's going to soon trickle down into PCE and CPI as we go on, right? And while I think there is a case for a 25 basis point cut in September, I definitely think that, maybe it's due. I think being vigilant around the upcoming inflation data is equally important, both in terms of what the economists and the Fed do, and just as investors ourselves. I think in terms of positioning, personally, I'm positioned in a way where hopefully I'll be able to capitalize on some higher growth small or mid cap names. The AI trade is still on, in my opinion, for the rest of the year, but I think we're going to see a broadening out away from that Mag 7 driven dominance and growth, right? I think we're going to see some of the other players in the market, the S&P 493, that are going to leverage AI for, maybe companies that are going to leverage AI for superior efficiency, or just, use AI for better product offerings. And I think that's where the winners are going to be going forward if we start a rate cut cycle. Now, moving away from macro and onto earnings, this week I just kind of wanted to focus on our beloved consumer, right? I mean, in light of potential rate cuts, I think it's important to kind of look at the state of the consumer, and there were three companies of interest that reported their results this week. So looking at the first one, Home Depot, this was a mixed earnings, a mixed bag. We see that for the second straight quarter running, Home Depot missed analyst consensus, but they maintained their guidance for the year. So what this implies is essentially the rest of the year is going to be better for them. EPS came in at $4.68 adjusted versus the expected $4.71. Revenue came in at $45.28 billion versus an expected $45.36 billion. Shares were up about 3.8% for the week. And yeah, looking at it a little deeper, net income was down slightly from last year, right? It came in at $4.55 billion or $4.58 a share, and this was down slightly from $4.6 4.56 billion, sorry. And sales were up about 5% from the year ago. So margins have decreased, right? And this could very much be related to higher costs. And it's the first time since 2014 that Home Depot fell short on both top and bottom line expectations. So they had a good run. And obviously, with this, results don't look too great on paper, right? You can see that the overall consumer still seems a little stretched to be spending on home improvement. But there were some encouraging signs amidst all this. Big ticket transactions, which the company defines as over $1,000, that rose 2.6% compared with the year ago quarter. 12 of its 16 merchandising departments posted year-over-year sales gains, which is encouraging. And, year-over-year sales trends improved in each month of the quarter, with comparable sales up 0.3% in May, up 0.5% in June, and 3.3% in July. So a nice pop in July. Another encouraging takeaway was that their CFO spoke about guidance, and, with their guidance, they don't factor in any rate cuts, which could actually spur more home improvement projects, right? We're obviously going through the months of summer where people are typically working on their homes. Now you see rate cuts come in, and if you believe that we are positioning for some rate cuts, Home Depot could actually see some pickup in sales, especially if we start to see mortgage rates come down and we start to see an uptick in the housing market. This could be positive news for the company. Now, another player that operates in the exact same home improvement space, Lowe's, that I spoke about last earnings season as well, they also reported earnings this last week. So unlike Home Depot, they beat expectations, and this was driven by an improvement in sales and a pop in July. Well, we saw this trend with Home Depot as well, right? July being their solid month. EPS came in for Lowe's at $4.33 adjusted versus $4.24, which was expected, and that was up 5.6% year over year. Revenue came in just about as expected, $23.96 billion. And I think one of the big pieces of news was the announcement of the acquisition of Foundation Building Materials, right, for $8.8 billion. What this company does, FBM, they are a distributor of drywall, insulation, and other interior building products for, large residential and commercial professionals. So I guess much like Home Depot's strategy, Lowe's is trying to mitigate the issues with the consumer and high mortgage rates by trying to attract more business on the home professional side, right? Targeting the professional home improvers. So two acquisitions, their previous acquisition of Artisan Design Group, ADG, which is a company that provides design services and installation of, flooring, cabinets, and countertops for home builders and property managers, and now FBM. It's a good strategy, to reduce that dependency on home buyers and reduce the dependency on the average consumer. It does, I do think home buying and home improvement tends to be somewhat cyclical. It comes in cycles, right? You see an uptick in the summer months, and to be honest, it's not every year that people are doing something or the other, right? Typically these things have longer cycles, and having that professional demographic to tap into as well grows that target market. It hopefully smoothens some of the lumpiness or waviness in sales. Hopefully it smoothens it out. Now, Lowe's updated guidance reflects the acquisition of ADG, which is why it looks drastically different. But to think about their strategy, I think their efforts to reach more Gen Z and millennial folk will actually help them in the longer run, right? If you think about where we're heading, these are the people that are going to be buying and improving homes going forward. Targeting them increases that mind share and may prove to be effective, especially for first-time homeowners. Home Depot is kind of the staple, right? And Lowe's, I would say, is second fiddle. But increasing that mind share in the younger generation through, their deals with Messi, the NFL, Mr. Beast, all of these should go to good use and increase that mind share and hopefully increase their market share as well. While I'm not going to be buying either Home Depot or Lowe's as stocks at the moment, it's always good to kind of gauge the state of the consumer and the home buyer. And the fact that both these companies are attempting to reduce dependency on the homeowner shows that to some extent even they are betting on volatility and uncertainty within that target market, right? And I guess if there is a drastic change in mortgage rates and the macro data for home purchases and building improves immensely, then perhaps a case could be made for these companies. But until then, I'm sort of just monitoring and staying clear of these two names, but using them as a general guideline for how the consumer is faring at the moment. And the last company I want to talk about, which I would argue is probably the most indicative of how the consumer is doing, is Walmart. Now, Walmart beat top line expectations but fell short of their bottom line. And this is the first time it missed since May 2022. EPS came in below expectations at 68 cents adjusted. What was expected was 74 cents, and revenue came in higher at 177.4 billion versus the expected 176.16 billion. Now, their consolidated revenue in Q2 grew 5.6% in constant currency terms. E-commerce sales were up 25% globally, and US e-commerce was up 26%. International sales were up 10.5%, and this was led by China, Walmex, and Flipkart, which is in India. So it now expects sales to grow between 3.75 and 4.75% for the fiscal year, which is up from previous expectations of 3% to 4%. They raised guidance for adjusted earnings per share slightly to $2.52 to $2.62, which was up from the previous range of $2.50 to $2.60 per share. So just slight increase in EPS outlook. Now, I think more than the results, though, like more than the actual numbers, it was the commentary that was interesting to me. John David Rainey, their CFO, mentioned that the customer seems to be extremely resilient as spending continues to be more or less consistent. Now, this is important, right? Walmart have eaten some tariff-related costs, yes. Some are being passed through, and some are going to be passed through in the future because they suspect that tariff-induced cost pressures will continue to drive prices higher. And as sort of expected, we see the middle and lower income households perhaps be more sensitive to these tariff-related price increases, particularly in discretionary categories. Of course, this kind of resilience is not going to last forever, but Walmart seemed to be doing a pretty good job in front-running a lot of imports to try to keep prices as low as possible. So from an inventory perspective, they seem to have done a good job in front-loading so that they mitigate as much of the tariff impact as possible. Now, the big opportunity that I see here for Walmart is in their e-commerce business, right? And sales, continue to jump 20+%, and profitability doubled from a quarter ago, which is huge. Now, of course, this is a big part of their growth story that's been priced in, right? And it's important to note that Walmart, their e-commerce business, their online presence is still a long way from Amazon, right? And they predominantly do remain a brick and mortar store business. But it's the trajectory that interests me the most at the moment. It's still trading at pretty high valuations as a company. Probably not going to get in at the moment. I think to do that, I'd have to see a little bit of a pullback in terms of price. Maybe one or two disappointing quarters, and we start to see that price move downward, and hopefully we can get a good entry point into a business that has done so well in recent times, right? And I think I'd also want to see Sam's Club make more of a dent into Costco's business, right? I don't see the value that Sam's Club is offering be drastically different from what Costco is offering, or drastically better. Now, with Walmart, much of their gain has come at the detriment of their competitor Target, right? And now with Target getting a new CEO, I actually think it'll be interesting to see whether that retail giant can stage some sort of a comeback, right? And from a stock perspective between the two, I'd probably be more interested in looking at Target over the coming quarters and monitoring their turnaround or comeback strategy and the dialogue that will come from their new CEO and management. So I think with regards to the stock itself, I'd monitor Walmart. I'd look for maybe a pullback, but I'd also be keeping an eye on Target and how the new CEO talks about the business and strategy from here on. But overall, looking at the consumer, I think it's fair to say that yes, the consumer seems resilient. Labor market has shown some weakening, so I'm not sure how much longer this resilience is going to last, but maybe a rate cut is warranted, and that's something clearly traders are pricing in for the coming September decision. And I do want to remind everyone that everything I say is not to be taken as formal investment advice. It's all purely my opinion and is predominantly for informational and educational purposes. So on that note, I thank you for listening. That wraps it up for today's episode. I'm Anurag Birla, and this is the Finance Now podcast.
If I just lay here, would you lie with me and just forget the world?